Rental cash damming. You guys are here because you either saw me on social media, your realtor has invited you, or maybe you're a past client of mine. Either way, you're here because you're looking to structure your rental property differently. And I'm going to show you an advanced strategy called rental cash damming that will allow you to get the CRA to pay off your mortgage years faster. There's many other benefits that come along the way with this. That is only one of them. I'm going to show you all of them. I'm going to show you how rental cash damming works. And of course, I'm not just going to show you those two things. I'm going to show you next steps and how to get started. So before we do get started here tonight, just a couple things, a couple housekeeping items. Let's be present. Let's limit the distractions. I know we all have short attention spans today, but I'm guilty of it too. Let's just exit out of all of the different browsers you've got going on. If you're on your computer, if you're on your phone or tablet, let's just exit out of all of the different browsers you got, any conversations. Because if we are present, we're going to get the most out of this presentation tonight. And I'm the kind of guy that likes to get straight into it and to the point. So no fluff or filler. So I will be very quick and brief here tonight, just give you the straight goods. So we're going to be here maybe 25 minutes tops. So that leads me to my second point here. Any questions that you have, just drop them in the chat and I have Kyle in the background, our head underwriter. He's going to answer any questions that you guys throw in there. And if there's anything that we don't get to in time, then we will send you an email after this with a custom answer. So, all right, what is this presentation going to help you accomplish? That's the main thing. Let's get into it. Number one, how to save hundreds of thousands in mortgage interest. Number two, I'm going to show you how to turn a negative cash flowing property into a good thing. We're all feeling that pinch right now. Maybe some of you are sitting there with nice positive cash flowing properties, but that's not the case for a lot of people. How to get the CRA to pay off your mortgage years faster. I just touched on that as well. How it all works and next steps. So who is this presentation for? If you have a primary residence with a mortgage, you own one or more rental properties and they're owned properties in Canada, this presentation is for you. So before we get into it, I'm going to be very brief on this, but if you don't know who I am, let's just touch on that real brief. Joined forces with Brandon Love 2 years ago. So Brandon's on the left there. He's my business partner. We joined like about 2 years ago. We realized our businesses were very similar and aligned, and we were both running our mortgage business. And the main thing we cared about was our client journey and having a really positive experience for our clients. So that's what made us join forces about 2 years ago. And since then, we've opened up our own brokerage, Tango Financial. We are the fastest growing brokerage in Canada to this date. And we also pivoted to advanced mortgage strategies not too long ago as well, because we saw there was a big gap in the marketplace in terms of people teaching these sort of strategies, because financial advisors weren't, accountants weren't, and there was even like mortgage brokers, there's not many of them that teach this, because a lot of it is just transactional purchase, refi, or renewal mortgages, whereas we need some of the more of these advanced strategies to help Canadians get by financially. So that's where we started pivoting, and that's where we're at today. So cards are stacked against us here in Canada. Like, let's face it, we're feeling the pinch, like inflation, the cost of living, everything is up. Our incomes may not have aligned with that as well. So like I said, inflation's rising faster than what our income is currently doing right now in terms of the income going up. Rising cost of home ownership, it's a lot more expensive out there to buy a home, rental properties as well, higher interest rates, rental properties for the most part in the major markets have negative cash flow. So it's harder to find a good deal. And high taxation. Canada is notorious for our taxation here, whether you strongly believe in where those tax dollars are going, we are still taxed at a very high amount here. So with that said, what worked in the past no longer works today. There's a need for these advanced mortgage strategies to be taught to Canadians, and that's where we're coming in here today. Let's use your mortgage as a tool to accelerate your wealth goals. So I want you to think about a mortgage differently here today. A lot of people think of a mortgage as something they need, which of course that is true, but they think of it as like a necessary evil. Like we need that debt from the bank in order to finance our home. I get that, cool. But let's look at it differently. Let's look at it as a wealth accelerator, a tool. So what's cash damming? It's a CRA approved tax strategy that allows Canadians to claim deductions on their primary home mortgage debt. So unless you live in the States, it's not the standard to have your primary home mortgage being tax deductible. We cannot write off the interest on our primary residence mortgage unless you are using a strategy like cash damming. It's reorganizing existing cash flows and payments that you're currently already doing. There's no additional cash inputs. That's why I love cash damming. You're not inputting any additional cash into this strategy. It's just reorganizing the cash flows. And I'm going to explain how that works. There's no additional leverage. We're not taking any more money out and investing it. That's more of a cash damming strategy, or sorry, that's more of a Smith maneuver strategy. We're not talking about that here today. We're not leveraging any additional debt. We're earning free tax refunds, then using that to pay down the mortgage. That is one strategy, the main one. You can do whatever you want with the tax refunds that we're going to show you how to get, but the majority of people do use it to pay down their mortgage, which in turn reduces interest costs and shaves years off your mortgage. Reinvest those payments. So this is kind of like the next level here is you can reinvest the payment savings to build more wealth and more assets. So you can use these payment savings and the tax refunds that you get and allocate it towards more investment properties. Excuse me. So let's look at how cash damming works. Let's look at the overall flow of the money. So like traditionally, we make our regular mortgage payment. That's, of course, everyone does that. But here's where it looks a little different. A lot of people, what they'll do is they'll use the rental income on their property, the rental income on their rental property, and they will flow that through to their rental expenses. Pretty standard. And we're talking about rental expenses like your property taxes, condo fees, your maintenance fees, anything that's associated with that rental property. That's from an expense perspective. Typically, people are using the rental income and paying that. Of course, that's what most people do, but it is a missed opportunity. Let's look at it differently. Let's use the rental income. Instead of flowing it to the rental expenses, let's pay down your primary residence mortgage faster. So we're going to make an extra mortgage payment every single month. And by doing that, you're going to have the line of credit that's attached to your primary residence mortgage grow from a limit perspective. The limit is going to grow as you pay down the mortgage. You need to have your mortgage set up properly, which I'll dive into more detail on that. You're going to reborrow the money that you just paid down on the mortgage and reborrow it from the line of credit. And then you're going to then pay those rental expenses. So I'm going to run through this again in more detail in a second here. So if this is still a little confusing, don't worry, it will be more clear to you, but just look at it as a difference of flowing the money. Instead of flowing the money through the rental property, we're just doing kind of a loop through your primary residence mortgage, and then it's still going to land where you are paying right now. You're still going to land on the rental expenses. You're just flowing it through the primary residence mortgage. Now, why are we doing this? Anything you pull from the primary residence mortgage for the purposes of investing, it is now tax deductible. So you can imagine doing this year in, year out. That is going to be a lot of tax refunds. I'm going to show you all the numbers in a second here. So let's look at an actual case study. So you got your principal residence mortgage. Let's say it's $500K that you have remaining. You've got a 30-year amortization. So that's the length of time it's going to take to pay down the mortgage. Your payment is $2,804 with an interest rate at 5.45. Now, rates are a bit lower. Doesn't matter. I'm just showing you an example. It doesn't matter what the rate is. You have a 40% marginal tax bracket. So this is based on how much income you make. This is pretty standard for anyone that makes, I believe, 100K or more. You're looking at a 40% marginal tax bracket. Annual rental expenses. So let's look at the expenses from an annual perspective on your rental. So you've got the 500K rental value. That's how much your rental is worth. A 375K mortgage left on that rental. And here's your rental property expenses. Again, this is just a case study. I'm going to show you the numbers in a second. Your mortgage payment from an annual perspective, 25K. You've got your expenses here, which all equal out to 33,000. So your annual debt conversion using this number is 33,000. Now, what do you mean by debt conversion? What I'm talking about here is this is the amount of money we're flowing through your primary residence mortgage. Every single year, that 33K is now going to be tax deductible. We are going to be able to write off the interest on this money here every single year. So let's go back to the flow of money. We've got your rental income. Instead of flowing it through the rental property, we're going to flow it through your primary residence mortgage. That's going to be the $33,000 a year that we just discussed. By doing that, we're going to take it back out from the line of credit and pay your rental property expenses, $33,000 a year. So now you've got debt conversion on your line of credit of $33,000 in year one. So let's dive into the financial benefits of this strategy. So using that same case study I showed you, you've got your debt conversion right here, 9 years. So debt conversion simply means this is not the mortgage freedom date. This isn't when you have your mortgage paid off entirely. This is the amount of time it takes for your mortgage to now be fully tax deductible. So starting from year one, it's going to take 9 years for that debt to be fully tax deductible. In the course of paying off your mortgage in the entirety of the term or of the amortization, your total tax refunds are 117K. So that's a big number there, 117K. You're saving 97 payments, 97 mortgage payments, which equate to $272,000. And looking at a pre-tax income savings, we can't assume that we're just saving 272K. Using a 40% marginal tax bracket, we're going to have to make $453,000. So imagine that. You have to make $453,000 in order to pay and to save 272K. So we're in fact saving you this much money from an income perspective. So pretty powerful just by switching the way we flow the money in your rental and primary. And a bonus to this is once you pay off your mortgage entirely, I'm going to show you how this shaves off the years off your amortization. Say you're shaving off 8 years off your amortization. That's 8 years where you can now invest that money that you would have otherwise been paying towards the mortgage. You can invest that and get a bigger return, whether you're buying a rental property or whether you're investing it in stocks. You're going to have a really big return. That's kind of the bonus on this. That's what I really like. So here, let's go through the actual numbers. This is an example of a client of ours. This is different than the numbers I was just showing you. This is more current with where rates are at today and what they have right now. So this is a custom budget that we give every single client. And there are more numbers than this, but I'm going to keep things super simple for this presentation here. So the primary residence, we're looking at their home right now. Their current value is $750K. Their mortgage balance right now is $450K. You've got the mortgage interest rate at 4.99%, amortization 30 years. So their monthly mortgage payment is $23.98. So now we've got the rental property, and we're just using one rental property. Keep in mind, if you have multiple, this works really, really well if you have more than one. But as long as you have one, this strategy works. So the original purchase price of that rental property is $342. The current value is $410K. LTV 40%, mortgage balance. So don't worry about that. That's just the loan to value. The mortgage balance on this is $165K. Mortgage interest rate, because it is a rental property, they are paying a bit of a premium that is higher than what we have today. But again, rate doesn't matter right now. Amortization 30 years, and the monthly mortgage payment is $930. Not bad. Okay, so now let's look into the expenses associated with this rental property. So I'm just going to skip ahead here. Here's all their expenses. If you look at their total monthly adding everything in with their monthly mortgage payment, they are paying $1,361 a month. So this is their mortgage payment, all of their expenses associated with the property. So now here's what we're going to do. Let's look at their rental income that they have coming in on a monthly basis. So they've got $1,400. They are cash flow positive on this property. So we do not have to cover any shortfall here. That is for a different discussion. I'm not going to go into that today, but just keep in mind, we've got the rental income, $1,400. If it is a negative cash flow, this strategy can eat up that cost and really help with that pain that you might be feeling right now from a negative cash flow perspective. So the cash flow inputs are $1,400. So now if we look at the overall benefits of implementing this strategy, again, with that flow of money that I was showing you, by doing that, we are shaving off almost 8 years off their amortization just by changing the way they move their money. And this is on their primary home mortgage, by the way. So the debt conversion, what this is the amount of time it takes for the debt to be fully converted to tax deductible debt, which we call good debt, because we get to, again, write off the tax, the interest on that debt. So 12.67 years is when we will hit that debt conversion date. Total tax refunds, 73,000. Number of payments reduced, 92. Savings, so the future payment savings, 220. Pre-tax income savings, 389. So we're using a number that's relatively smaller than most people have. We're using the 1,400 rental income and a mortgage payment of 930, right? So these are smaller figures than most people have. And even using that, still quite a bit of benefits here. So let's just look at how people are typically running their rental property right now. You use your rental income to pay for rental expenses, which equates to relying on rents to increase and have the property appreciation to happen over time. Of course, rents increasing and appreciation, those are great things. That's part of the reason why we buy rental properties, especially that appreciation, which will happen over time. But to rely on that year in, year out, in my opinion, it's a bit risky and it's a missed opportunity. But the new school approach is to use the rental income to prepay your primary residence mortgage, like we just showed you, have the CRA accelerate the mortgage pay down and investment growth. And you might be asking, how is that possible? How's the CRA doing this? Well, it's the tax refunds. You're getting the tax refunds by the CRA and you're allocating that towards the mortgage, or you use it for your investments. You can do whatever you want with that money. Keep in mind, you can supplement your lifestyle. You can just say, hey, you know what? We're going to take the tax refunds every year and we're just going to go on a trip. Cool. You can do whatever you want with that money. This is the wealthier, much, much wealthier way of running your properties. So the common questions that I usually get from the cash damming strategy is, doesn't the line of credit have a higher interest rate? Yes, it does. But keep in mind, anything on that line of credit that we are cycling through, it's tax deductible. So using your marginal tax rate, let's say it's 40%, we get to write off 40% of that interest. So it's always going to be less than whatever you're paying on your actual primary residence mortgage instead of your HELOC. How much equity do I need? You need at least 20% equity in your home in order for this strategy to work. Will my accountant understand this? What we do is we always talk to our clients' accountants. We give them the strategy. We show them what we're doing. Most of the time, they understand it and they're good with it. Some are, to be quite honest, a bit lazy and they don't really want to proceed with doing this because it is extra work for the accountant. If that's the case and they just don't want to do the extra work, we do have some accountants that our clients can work with. Can't I already claim deductions on my rental? Yes, you can. This is separate from the deductions you're already claiming on your rental property, which is the really cool part. Anything you're already claiming for expenses on your rental, you continue doing that. What we're showing you here is actually going to show up on a different line item on your T1s, your tax returns, and it's an extra tax return that you're getting. So any questions in addition to this, just drop it in the chat. Again, Kyle will answer any, and I'll get to them over email if we don't get to all of them. So what's included in this? We have the cash damming experts. So myself and Brandon, that is who you get for cash damming. You've got your mortgage broker, that's us as well, and Kyle. So we have both teams firing at all cylinders and understand the concept very well. We've got the accountants, we've got the realtor, we've got the insurance provider as well. So every specialist on this team understands cash damming. There's nothing for you to do or vet. We have them all in-house here. So how to get started. If you want to get started on the strategy or you want us to run the numbers for you, simply book a call with me. I'll put the link in the chat, or Kyle will put the link in the chat here, and you can book a call with myself. It's a 15 to 20 minute call, complimentary call, and we'll just see if this strategy will work for you. And after that, if we are proceeding, you will get a customized cash damming implementation that will be sent over to you, and then we'll go over some next steps. So if you have any additional questions that you want to email us with, that's my email down below as well. So you can just take a picture with your phone here, take a screenshot with your computer, whatever's easiest, and just click the link in the chat so at least you have it open. And if you don't get the link in time before we close this out, just send me an email there. So just make sure you take a picture of that. So before we wrap things up here, I just want you to think before we leave, use your mortgage as a tool. It will change your life. Let's not look at it the traditional way of how we look at mortgages. Let's look at it as a tool. Thanks for coming out, guys. Cheers.